Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Lumentum.
If you find our talks useful, please consider subscribe, like, and comment underneath because it really helps us out. So if you followed Lumentum, maybe a few years ago, you probably remember them as this relatively sleepy, cyclical telecom supplier.
Right, exactly. Just making components for routing standard phone and internet traffic. Nothing crazy.
Exactly. But today they are literally the reason that these multi-billion-dollar artificial intelligence chips don't just melt down in some massive data bottleneck.
Yeah, the transformation is, it's pretty unbelievable.
It is. In just the last 12 months, this stock has gone from an afterthought to a 1,500% rocket ship?
Yep. Just year-to-date alone, it's up about 140%.
Which is insane. Like, when you pull up that chart for the listener, it doesn't even look like a stock anymore. It just looks like a vertical line.
Literally straight up.
Yeah. Right. So our mission for you today is to really understand the mechanics behind this corporate metamorphosis, and figure out if this historic breakout is actually sustainable for your portfolio.
Because the velocity of this pivot, it really makes it a fascinating case study in wealth creation. To understand that crazy chart, you have to look at the massive physical roadblock that the whole AI industry just slammed into.
The power heat issues, right?
Exactly. And how one specific technology, riding this massive wave the industry is calling the optical supercycle, basically became the only viable solution to that roadblock.
Let's unpack that roadblock, because I think visualizing it is it's the key to this entire investment thesis for you listening. So think about the most advanced AI chips on the market right now.
Like Nvidia's GPUs.
Right. Imagine those chips are these state-of-the-art, hyper-fast sports cars. They can process data at just blinding speeds. But to train a massive AI model, thousands of these sports cars need to talk to each other constantly inside the data center.
Yeah, the industry calls that east-west traffic. It's not just data going out to your laptop, it's data moving horizontally between rows and rows of servers.
Right, and that horizontal movement is where the physics of traditional computing just sort of started to fail, didn't it?
It absolutely did. Historically, those networking cables connecting the servers, they were made of copper. So if we use your sports car analogy, running those cars on copper wires is like taking a Ferrari and forcing it onto a one-lane dirt road.
Oh, wow. Yeah, that's not going to end well.
No, it's a massive traffic jam. Pushing that much data through copper generates severe friction, and that creates catastrophic heat and signal degradation over long distances.
So it doesn't even matter how fast your AI processor is.
Exactly. If it's stuck in a data traffic jam on a copper wire, you lose all that performance. You're just wasting money.
Which brings us right to Lumentum's solution.
Yeah.
What they're doing is they're taking the data out of those sports cars and beaming it through fiber optic glass using lasers, which means there is virtually zero friction. It's the difference between driving on a congested, overheating dirt road versus teleporting. They are building these multi-lane, zero-friction superhighways so those AI chips can finally hit their top speed.
But building those light-based superhighways, it requires incredibly specific, highly engineered components. And this is where Lumentum has dug an enormous technological moat.
Right. Let's talk about that moat, because it's not just software, it's physical hardware. Right?
Very complex physical hardware. Their true barrier to entry revolves around a material called indium phosphide.
Indium phosphide?
Yeah. It is the foundation for what are known as electroabsorption modulated lasers, or EMLs for short.
Okay. Whenever we start throwing around terms like indium phosphide and EMLs, I always like to pause and translate that into the actual business advantage for the listener.
Yeah.
Like, why is this a moat? Is it just that they have a patented design, or is it fundamentally difficult to manufacture?
Oh, it is exceptionally difficult to manufacture. You have to understand, indium phosphide isn't like silicon. You cannot simply stamp it out in some generic foundry. Growing these microscopic crystal structures at high yields without introducing microscopic defects is essentially a dark art of manufacturing.
A dark art? Wow.
Really, it is. It requires years of trial, error, and immense capital. And that complex learning curve is exactly why Lumentum currently controls roughly 50 to 60% of the high-end EML market.
That is a massive market share. And those specific lasers are, they're currently the only components capable of supporting what are known as 1.6T optical transceivers.
Which is the new gold standard.
Right. And let me just clarify that acronym for you real quick, because you will hear it constantly in the space. The T stands for terabits, 1 terabit is 1,000 gigabits, so a 1.6T transceiver is capable of moving literal libraries of data across a data center in a fraction of a second.
And moving that data is the absolute lifeblood of AI. But, what took Lumentum from just holding a great technological advantage to triggering a 1,500% market explosion was the ultimate cosign.
The kingmaker.
Exactly. The validation came directly from Nvidia. On March 2, 2026, Nvidia didn't just give them a nice seal of approval. They announced a $2 billion direct investment in Lumentum.
$2 billion. With a B.
With a B, coupled with a massive multi-year purchase commitment.
So Nvidia essentially looked at the landscape, realized their multi-million-dollar data centers were going to bottleneck on those old copper wires, and decided they just needed to heavily underwrite the company building the laser superhighways.
That's exactly what happened. That investment contractually locks in Lumentum as the primary supplier of external light sources for NVIDIA's next-generation AI factories. And that's all the way through 2028.
Which is huge.
Yeah.
But why them?
Yeah.
Because they have competitors, right? Like Coherent.
Yeah, Coherent is a fierce competitor. But NVIDIA chose Lumentum for a very specific, highly measurable reason, and that is power efficiency.
Ah, right. Power is everything.
Yep. Thanks to Lumentum integrating their silicon photonics directly into NVIDIA's switch architectures, specifically the Quantum-X and Spectrum-X platforms, Lumentum actually enjoys a 3.5x power efficiency advantage over the competition.
Wait, 3.5 times more efficient. Let's make sure the listener grasps the gravity of that number. Because by integrating the laser tech directly with the silicon chip, they eliminate the energy loss that usually happens when components are physically separated, right?
Precisely. You don't have to push the signal as far physically, so you save a massive amount of power.
And in a modern data center, power is the ultimate constraint. A 3.5x efficiency advantage isn't just like an incremental improvement. That is a chasm that competitors cannot simply leap over with a quick software patch.
It forces the hands of the data center architects. I mean, when you are constrained by your local power grid, you don't have a choice. You must buy the most efficient component available, period.
Right.
And that technological monopoly is now flooding directly onto Lumentum's balance sheet. The numbers are just staggering.
Well, let's get into those numbers, because it's one thing to have the best tech in the lab, but, I've seen plenty of brilliant tech companies totally fail to actually monetize their inventions. Let's look at the actual cash.
Let's do it.
So their Q2 fiscal year 2026 results, and that quarter ended December 27, 2025, showed record quarterly revenue of $665.5 million. That is a 65.5% increase year over year.
And the underlying composition of that revenue, that's what really tells the story of their transformation. Their cloud and networking segment now makes up approximately 88% of that total revenue pie.
Wow, 88%.
Yeah. The legacy telecom business, with all its notorious cyclicality and sluggish growth, it has been entirely overshadowed by AI data center demand.
And because they're selling these ultra-advanced proprietary lasers instead of commoditized telecom routers, their profitability is expanding aggressively. I mean, their non-GAAP gross margins surged to 42.5% in Q2.
Which is incredible.
Right. For context, in early 2025, those margins were sitting down in the 32% range. In hardware manufacturing, a 10-point jump in gross margin in under a year is it's virtually unheard of.
It really is. And that operating leverage drove their non-GAAP earnings per share to $1.67, completely crushing the analyst consensus of $1.41.
A huge beat.
Huge beat. And the forward guidance for Q3 projects, revenue accelerating even further, somewhere between $780 million and $830 million.
But the true focal point for Wall Street, the thing everyone is talking about, is management's newly unveiled 2028 North Star model, right?
Oh, yeah. They are targeting an annualized EPS of over $30.
Okay, I have to play the skeptic here on behalf of anyone listening who's thinking about risking their capital. A $30 EPS target on a company that was literally struggling to find its identity 2 years ago.
I know how it sounds.
Is management getting completely out over their skis here? Because we have seen hardware booms fizzle out spectacularly. Think about the pandemic-era cycles, where everyone overordered laptops and servers, and then suddenly demand just evaporated and inventory piled up. Why should anyone trust a 2028 projection in a tech sector that reinvents itself every 6 months?
That healthy skepticism is exactly how you protect your portfolio. But analyzing the structure of this demand reveals a totally different beast than a pandemic consumer boom.
How so?
Well, consumer cycles are discretionary. You don't have to buy a new laptop. This, however, is a fundamental, contractually secured infrastructure build-out.
But a contract is only as good as the market demand behind it. I mean, if the AI bubble were to pop, couldn't a company like Nvidia just pay a break fee and walk away?
I mean, legally they could, but the transition from the current 800G networking speeds up to 1.6T and eventually 3.2T, it isn't an optional upgrade for these hyperscalers.
It's mandatory.
It requires a total replumbing of global data centers simply to maintain baseline functionality for these massive language models. Furthermore, NVIDIA's commitment provides a verified baseline of demand.
Right.
So that $30 EPS target for 2028, it isn't built on a hope that consumers keep buying. It reflects the mathematical reality of holding a 60% market share and a mandatory global infrastructure upgrade that is already fully funded.
That structural reality is clearly driving a total frenzy behind the scenes on Wall Street, because a 1,500% gain doesn't happen just from retail investors buying a few shares on their phones. We need to talk about the market mania, the technical breakout, and really what is forcing institutions to buy.
The market sentiment has shifted into a relentless accumulation, and a profound catalyst occurred on March 10, 2026, when Lumentum was officially included in the S&P 500 index.
Now, for you listening, S&P 500 inclusion is much more than a prestige badge. It fundamentally alters the physics of the stock.
It forces passive fund accumulation.
Exactly. Every single index fund, every ETF, and every pension fund that tracks the S&P 500 suddenly has no choice.
No.
They absolutely must buy Lumentum shares to accurately mirror the index, regardless of whether they think the current price is fair.
And that mechanical buying pressure strips a lot of normal price discovery out of the equation.
Yeah.
Institutional ownership of Lumentum has soared to an astronomical 94%.
94%. That's almost the entire float.
It is, and that shareholder base is anchored by the absolute titans of the financial world firms like BlackRock and Vanguard. Having 94% of the float locked up by institutions creates a massive floor of support.
And from a charting perspective, the momentum has completely decoupled from any historical trading ranges. It has passed the Mark-Minervini trend template, which basically means it possesses a perfect technical rating for momentum and trend.
Yep, hitting all the criteria.
And the underlying engine for that trend is easy to spot. The earnings growth is accelerating at an incredible 297.6%.
So when you combine triple-digit earnings acceleration with forced S&P 500 inclusion, the sell-side analysts just have to scramble to revise their models.
There's playing catch-up.
Completely. They end up chasing the momentum, which creates a really powerful positive feedback loop in the financial media.
You aren't kidding about them scrambling. Just look at the recent barrage of price target revisions. Morgan Stanley came out and raised their target to $710.
Right.
Then JP Morgan steps over them, upgrading to $950.
Yep.
And then Northland drops a massive $1,000 price target on the stock. You literally have Wall Street analysts projecting a 4-digit share price on a company that was trading for a fraction of that a year ago.
It's wild. But while that overwhelming bullish mood is intoxicating, critical wealth building requires looking at the other side of the coin.
Absolutely.
Because whenever you see a $1,000 price target and a stock that has run 1,500%, the risk profile has fundamentally changed.
Exactly. The most important question you should be asking right now is, what is the catch? Where is the hidden trapdoor if you jump in at these elevated levels? So let's aggressively explore the bear case, because nothing goes straight up forever without serious turbulence.
The primary risk here is intense valuation anxiety. After this historic run, Lumentum is trading at over 90 times forward earnings and an eye-watering 30 times price to sales.
30 times sales. Let's pause on that. That is a steep multiple even for an elite, high-flying software company with 90% gross margins. For a company manufacturing physical hardware, a 30x sales multiple is astronomical.
It's priced for absolute perfection. That's the mathematical translation of that multiple. The market is already assuming they will hit that $30 EPS North Star target flawlessly.
So no room for error.
None. Any minor misstep in execution will be severely punished.
What does a misstep look like practically? What are the specific hurdles they have to clear this year?
The biggest hurdle is their massive domestic manufacturing expansion down in Greensboro, North Carolina. Internally, it's known as Project Vanguard.
Okay.
They are actively ramping up production lines to handle these next-generation components, specifically focusing on achieving high production yields for their 200G EMLs.
Yields are critical.
In semiconductor and optical manufacturing, yield is everything. It is the percentage of chips on a wafer that actually function perfectly.
Right.
If they suffer any delays in getting that Greensboro factory online, or if they miss their target yield rates on the manufacturing floor, it would trigger a violent derating of the stock.
Because when you are trading at 90 times forward earnings, investor patience does not exist. If you miss a deadline by a month, the market doesn't wait for you to fix it. They sell first and ask questions later.
Exactly.
But aside from execution, I was digging into the balance sheet.
Yeah.
And there is a line item that sounds terrifying.
Oh, I know what you're going to say.
Yeah, they currently have $3.18 billion in convertible notes that have been reclassified as current liabilities. Now, explain this in plain English, because to an everyday investor glancing at a balance sheet, suddenly owing over $3 billion in the short term looks like the company is about to face a catastrophic liquidity crisis.
It absolutely sounds alarming on paper. It freaked a lot of people out. But when you break down the accounting mechanics, it is actually a byproduct of their massive success.
Okay, how does owing $3 billion equal success?
Because those convertible notes are a specific type of debt. Investors loaned Lumentum money, but the contract stipulates that if Lumentum's stock price rises above a certain threshold, those investors have the right to convert that debt into actual shares of the company, rather than asking for their cash back.
Oh, I see. So because the stock has gone up 1,500%, the stock price is completely blown past that threshold.
Exactly. It's an accounting rule. Because the debt holders now have the right to convert at any time, the company must list it as a current liability. But practically speaking, those debt holders want the highly valuable equity. They do not want the cash. They are highly likely to convert those notes into stock.
So Lumentum doesn't actually have to drain their bank account to write a $3.18 billion check.
Not at all. It will result in a clean balance sheet resolution. Now, it does mean there will be some dilution for existing shareholders because the company has to issue new shares to hand over to those debt holders. But it entirely removes a massive mountain of debt without touching their cash reserves.
And speaking of cash, they already have a formidable war chest of about $1.16 billion in cash and short-term investments, plus that execution risk we discussed regarding the Greensboro factory. That risk is heavily backstopped by Nvidia.
That highlights the genius of the Nvidia partnership. That $2 billion direct cash injection entirely underwrites the capital expenditure for Project Vanguard.
So Nvidia is paying for the factory.
Nvidia essentially paid Lumentum to build the factory so Lumentum could guarantee their supply chain. It drastically de-risks the financial burden of scaling up to meet this insane demand.
That makes a lot of sense. So let's bring all of this fundamental analysis together into an actionable timelines for you. If you're watching this stock, what is the catalyst calendar for the next few months?
The immediate date circle in red is May 5, 2026. That is their Q3 earnings report.
And why is that one so critical?
This is a vital event because it will be the very first financial readout since the Nvidia partnership was officially announced. The consensus is looking for revenue at the high end of their $780 million to $830 million guidance.
But the revenue is almost backward-looking at this point, right? The market will be laser-focused on the forward indicators, specifically the size of their backlog and concrete updates on when the 1.6T production lines will be fully operational.
That leads directly into the second major milestone, summer 2026. This is when full-scale commercial shipments of the 1.6T DR4 OSFP modules officially begin.
Just to decode that a bit for the listener, those modules are the specific physical form factor that plug into the servers. When those begin shipping in bulk this summer, that is the moment the laser superhighway officially opens for traffic across the industry.
And zooming out from the immediate earnings calendar, we have to recognize the ultimate macroeconomic tailwind driving this entire sector. Global data center power demand is currently projected to hit an astounding 945 terawatt-hours annually by 2030.
Let me put 945 terawatt-hours into perspective for you. That is a 160% increase from today's power usage. That amount of electricity is roughly equivalent to the energy consumption of entire developed nations.
The grid simply cannot support that kind of unrestrained growth. Because power is going to become the single most scarce and expensive resource for these tech giants, the data centers absolutely require the most power-efficient interconnects available on the market.
It isn't a choice anymore.
No. Which brings us right back to Lumentum's 3.5x power efficiency advantage. It transforms their technology from a highly desired luxury into an absolute structural mandate.
Bringing it all down to the final verdict on our smart wealth thesis. Based on the massive moat, the financials, and the overarching macro environment, we're looking at an 8.5 out of 10 bullish score. Lumentum stands as the definitive picks and shovels play for the AI optical supercycle. They hold a monopolistic 60% share of a critical bottleneck component, and they possess Nvidia's $2 billion stamp of approval.
However, based on the valuation, this must be viewed as a multi-year hold. To truly capture the wealth-building potential here, you have to be willing to stomach severe short-term volatility, look past the 90x earnings multiple, and hold the stock through the actual execution of that $30 EPS 2028 North Star model.
The structural transition to 1.6T optics puts them right at the epicenter of the biggest hyperscale capital expenditure wave in human history. But as we wrap up today's analysis, I want to leave you with one final, slightly speculative thought to mull over. Oh, the wild card. The future of network architecture. Exactly. The current projections assume a relatively straightforward rollout. But right now, Lumentum's addressable market is undeniably massive. But what if the broader adoption of optical circuit switching, often referred to as OCS, moves beyond just Google?
For those unfamiliar, OCS is a mind-blowing technology where instead of converting light back into electrical signals to write the data, they use arrays of microscopic mirrors to physically bounce the light directly to its destination.
Like actual tiny mirrors.
Yes, Google has been pioneering this, but if that becomes the industry standard across all data centers,
the demand for advanced optical components would multiply exponentially. And furthermore, look at the competitive psychology of the hyperscalers. What happens when Amazon Web Services and Microsoft Azure get nervous watching Nvidia aggressively lock up all of Lumentum's premium manufacturing capacity?
that is the ultimate fear of missing out at a corporate level.
Right. If Amazon and Microsoft decide they cannot risk being bottlenecked, do they decide they need to mirror Nvidia's multi-billion-dollar supply chain strategy? If they rush to secure their own optical components through massive upfront investments, could Lumentum's total addressable market double faster than anyone on Wall Street has even modeled?
It introduces a scenario where the current capacity is severely underestimating future panic buying from the largest tech companies on Earth.
If the other tech giants decide they need their own $2 billion lock-in contracts just to guarantee a seat at the AI table, that $1,000 price target might actually be conservative. It is something to keep a very close eye on.